Alrighty, welcome everybody to an exclusive episode. This one's going to be just for the Patreon members, so I appreciate your guys' support. Thanks for trying out the Discord. I hope it's a lot of fun. I think we're having a good time. I was planning on doing one of these clubhouse meetings on Discord, a live podcast, if you will, where I go in and I give kind of a lecture on some subject, and I go through it, and then I ask for people to give their input. You can raise your hand, and then you get the stage, and you get to give some input as well. So that'll be a fun, interactive thing, but I forgot it was Easter weekend this weekend, so we're going to plan that for a different weekend. And I hope you guys are all having a good Easter weekend. If you have kids, it's fun to go on the Easter egg hunts and that type of thing. So my day is going to be wrapped up later in the day doing all that stuff, so I'm recording this right now, so you guys have something to do if you don't have Easter plans. Now, let me first go through and welcome the new members to the Discord. We have a lot of new members, maybe over 100 over the past couple days, so you guys are probably trying it out, seeing what it's like. If you stick around for a while, you'll get to learn some of the personalities. We have the chief analysts off to the right. They're people that I've selected on the Discord that have given very, I think, good input on different companies. They will challenge people that are investing in different companies and really assess what they're doing with their investments. We also have the different clubs, the Million Club, 500K Club, 100K Club, so on and so forth, down to the 25K Club. So that's the lowest club, is the 25K. The reason I made these is, first of all, we're here to grow our net worth. That's the purpose of it. You really want to grow your net worth and your wealth, and specifically in investments. So it's good to own a home that goes up in value and you get equity in your home, but that doesn't serve you the same way that having investments does. Because if you have a home, you have to have somewhere to live. And if you ever end up selling your home, likely the rest of the homes around you are going to be worth a lot as well. So the way that we track this is any investment outside of your primary residence. So any investment like crypto, rental properties that you own just because you're renting them out. Of course, stocks and bonds are included as well. Send me a screenshot of it. I'll add you to the clubs, and then we'll track your progress going from one club to the other. And I think that will be cool to see. Now, you don't have to do this. It's not something mandatory, but I think it is fun, and I plan on doing some other stuff with this later on. Now, again, welcome everybody new. We're going to be going over in this episode the questions for Joe. So if you're new here, this is something that I do regularly. Is I don't respond to these questions typically through text, right? I don't just respond through chat. I usually do a video where I go through and answer a bunch of these questions for Joe, similar to how I used to do them on the emails at the end of every episode. So I kind of made that a thing here. Gives you guys a more personalized response to these questions. So I'll be going over that. Before I jumped into that, I wanted to go over my portfolio. First of all, let's take a look at the passive income account. It's growing. I've added quite a bit of money recently, as well as we've had some gains, which have made the total portfolio go up a little bit. It hasn't performed amazing over the past 3 months, but it hasn't performed poorly. So it's not one of the portfolios that got really harmed over the past 2 or 3 months, but it hasn't done incredible either. It's just been kind of in between. 2,000 in the past day, 4,000 in the past month. In the past month, $2,000, 0.98%. See, wasn't in the red. In the past quarter, up 3%, so pretty good. And I think that a lot of the companies I'm buying are still undervalued. I think they'll do really well. When I'm looking at companies I'm buying telecoms, and then spoiler alert, I'm going to be introducing my position back in Verizon. So that's just what I want in my portfolio. It's a good dividend-paying company at a very low valuation that has a ton of free cash flow, very predictable business. If we had another downturn, another big market sell-off, I can't imagine Verizon getting that hurt. It really would not be one that I think would sell off, just like it didn't get that hurt in 2020 when we had the sell-off. So it's a resilient company as well because it has a margin of safety. It's trading at such a low valuation. And of course, it has the backing of Warren Buffett. He usually doesn't buy bad companies. So Verizon's probably one that they looked at certain metrics and saw this is a company with a large moat, highly competitive business that's difficult for new competitors to come in because the bar to entry in telecom is very high. You can't just quickly start a telecom company. And it's at a low valuation, has high free cash flow. So that's what I'm going to be buying. It has a 4% starting dividend yield. I've been buying a lot of AT&T. I've been buying a lot of Dominion Energy. I've been looking at all the companies I hold. I bought some JP Morgan equity premium. JEPI is one a lot of people are interested in that does equity linked notes to earn income as well as sells covered calls. And this one I'm up $700 on. It's been a good buy so far, and it's going to be paying me dividends like crazy in the future. I think it will pay me well over $1,500 a year, divvied up every single month. So I get the compounding with that. Now, And then we have real estate. And real estate, I've been looking to pick up more. I'm interested in store capital. I kind of hope this one trades down a little bit because I want to pick up more store capital. I just feel like Christopher Volk is a very good manager. And then in consumer, one that I also want to grow my position is Disney. It's just a matter of waiting for the right dip to buy it. I hope that Disney comes down a little bit and there's like some bad news or something that takes it down because I'd like to buy more Disney for the future. It's one of my strongest convictions and it's only $22,000 in my portfolio, which is like 10% of it. So I could grow that to a bigger one. Now, this is done okay. You guys see the type of companies I'm buying. High free cash flow, lots of predictable businesses. They're the boring companies, the ones that people don't want to own right now. Everybody wants small cap growth right now. They want just smaller cap, below $100 billion hyper growth companies. That's what people look for. Those are, in my opinion, becoming quite expensive. In fact, when I look at value, I think, right now, we'll go to the story fund. When I look at value with growth companies, I look at the story fund, I think a lot of them are in the bigger ones. I think that Amazon, Facebook, Google, Netflix, Salesforce, I think all of those are trading at reasonable valuations. I think it's the smaller ones that get in a tougher situation. A lot of those smaller sub $100 billion hyper growth companies have been bid up a lot by enthusiastic new investors to the market that so far have been trained to believe those type of companies only go racing up in value. And this recent 30% downturn in funds like ARK was a reality check for a lot of these investors. So don't be so enthusiastic to buy any company that's a small value growth company. Be very selective with what you're buying and look at valuations of them. Look at the valuation and the market cap compared to all the other metrics we look at. Now, just an update on the story fund. Currently $6,600 in returns. Not amazing, but it's not, it is what it is. I don't think that these companies are trading at anywhere close to the valuation they should be. I think that Spotify is a much better company than what it's getting bid up right now. I'm in the red by this one. I'm still very bullish on it. Amazon has basically sat flat for like 6 months. So I'm just kind of slowly accumulating shares, building a position in that one. Netflix, everybody knows how I feel about. Google's one that I think that I'm not going to lose money on. I just really don't believe I'll lose money on it in 5 to 10 years. If I was to give it a percent chance, I think it's like a 2% chance I lose money on Google over the next 5 to 10 years. And then, the same with a lot of these companies. As they get to the smaller positions, they get a little bit riskier, but they have higher potential returns. But these ones up here, I think are pretty safe bets. So I'm not satisfied with the returns, but the timeline has been very short. If I look at the timeline and I view the graphs comparing my performance, which is a blue line, against the S&P 500, this is accurately benchmarked. So this includes the weighted returns of every deposit I do. If you look at the returns, I'm almost completely even with SPY. And for a while, I was way above it. Then I went below it. When I was below it, did I panic and sell everything? No, I didn't sell everything. The only company that I sold over the past 3 months is Viacom CBS, which I sold at 50% gains, right? So I made some money on that company and I put that money into Amazon. Every other company that went down in value, I either just held them or I bought more of them. Spotify, I bought more. Salesforce, I bought more. Facebook, I bought more. Those are all companies that I accumulated more shares as we went and dropped down in value quite a bit and we went below the S&P 500. And then here we are. It's recovered over the past week a little bit to now where I'm basically matching the performance of the S&P 500 at 13%. So there you have it. Right now, I would have been the exact same having just invested my money in SPY if I invested at the same time periods. But I don't think it will stay like this forever because this portfolio really doesn't mimic SPY. It's way heavily weighted towards growth companies. I have some large cap growth companies, some small cap growth companies, mostly technology companies, and a lot of user-facing technology companies. So streaming services, payment services, audio, entertainment, and video services. That defines a lot of it. I think that the creative portion of the market, whether it's in video or audio entertainment or things like Adobe where you're creating content, very bullish on that part of the industry. So that's the performance so far. I'll give you updates on the S&P 500 or on the story fund versus the S&P 500, as well as a lot of these companies that are going down in dips that I'm buying. I give alerts on all of them. So I'll give alerts on them in the Joe's Trades channel. Here I tell you everything I'm buying. And when the story fund was falling, when all these growth companies were falling, I kind of put pause on my passive income account because those companies were doing fine. And then I started buying those growth companies. And you can see that. Like this buy here, $1,000 into Spotify, Google, Amazon, and Facebook. Only a little bit into Google, some into Spotify, and then a lot into Amazon and Facebook because these companies, I think, have really good risk-adjusted returns in the future. And I was doing the same thing, over a good period of time. I bought more CLTD, Amazon, again, Salesforce. I bought more CLTD, Facebook. I gave more updates on all of these that I was buying. Another one, I bought Google, Facebook, Amazon, Netflix, and Spotify. I sold out of DocuSign at a profit and Chewy at a profit. So those were ones that I took my profits in them and I put them in companies that are, I think, a little bit more predictable with the direction they're going. These bigger companies that I think have more predictability. So on the Joe's Trades channel, that's where I give instant buy alerts of everything I'm doing. You can see them there. But right now I'm kind of focused on the passive income account because everybody, again, is starting to buy the hyper growth companies, usually smaller ones. They're not as concerned about these boring companies like AT&T and Verizon. There's an update. Let's go ahead and jump in to the questions for Joe. Okay, the first one on questions for Joe. Let me try to zoom in so you can read these, maybe. Let me zoom in here. Scroll up a little bit. Okay, now you can probably see this a little bit easier. This one is Honest Man Marco. He says, trying again, apologize if you already answered this question. I watch everything and I didn't see it. I probably skipped over it. I'm going through, I try to get every question, but sometimes because there's like conversations, your question might be in between a conversation that I skip over. So if I miss your question on questions for Joe, just ask it again or direct message me. And maybe I didn't answer it because I didn't think it was applicable to a lot of people. But Honest Man Marco says, trying again, what to do with lump sum today? Okay, so you have a lump sum of money. You're asking what to do with it. The market is pricey and volatile. So if I'm afraid to put it all in, value is hard to find, and I'm reluctant to place too big of a bet on individual stocks, what would you do in terms of win, DCA over a long period of time, or what? Which sectors, individual stocks, ETFs? My investment goal is primarily dividends and safety in principle. Okay. I like the dividend growth and high yield as long as it's not a dying sector, no oil or tobacco, or too risky value plays. I invest only a little bit, 5 to 10% into growth. Thank you. And sorry for the long question. Not a problem. So Honest Man Marco, the first thing I'd ask you is why you're focused on protecting principal and dividends. Are you doing it because you're just trying to be cautious with your money and conservative with it? Or are you doing it because you're getting closer and closer to retirement? You're a little bit older, so you're really focused on protecting this big amount of money you have. Because my thought is, if you are younger, right? If you're like in your 20s or 30s and you're just starting investing, this is the period where you really need to focus on accumulation. So you want to invest in things that are down in value, that you have a high chance of getting good high returns with, and it's okay to take a little bit of risk doing that earlier on. Even with dividend investing, there's companies that are much riskier and not as risky. So like I said, I was investing in JP Morgan when people consider that to be very high risk, right? The banks were something that people didn't want to invest in. How scary to be investing in banks when all the restaurants were closed and all that type of stuff. But that's turned out to be my best performing holding because of that. So I would say if you're just starting off, and I don't know how much money you have into lump sum, but if you're just starting off and you have $5,000 or $10,000, I would get it to work very quickly. I'd put it in like the next week. I wouldn't sit around with money waiting for the best opportunity. There's valuable things to buy right now. I would put the money to work. If you're looking at $100,000 or $200,000, then yeah, I'd be a little bit more cautious with that sum of money. And I would break it up into chunks of 20,000 and say, hey, let's put 20,000 in over the next 2 months. And then the next 2 months after that, we'll put 20,000 in. But overall, I would try to get money to work as quick as possible if you have a good amount of time to invest. If you have another 10 or 20 years to invest, get that money working for you because you can't time the market. It's impossible to time the market. All you can do is look if there's deals worth buying right now. If you think there's any company that's worth buying right now, that gives you a good risk-adjusted return, that has a much higher likelihood of going up in value and producing a return based off the price than going down in value, those are worth buying. And there's companies that I could name off that I think are good risk-adjusted returns in both dividend stocks and growth. So I would try to get that money to work as soon as possible. I wouldn't sit around. The one thing I can promise you, and this isn't me saying it, it's Warren Buffett saying it, it's a lot of people saying it, I can promise you, cash is the worst asset to own over the next 10 years. I can promise you that. There's not going to be one that has as promising of a chance of losing value over the next 10 years as cash. I think you could buy any asset no matter what it is. I think, I think any SPAC, any company that no matter what you're putting it in, as long as it's a reasonable investment, it's going to make more money than cash. So storing your money in cash, you're guaranteed to lose money over the next 10 years. It's my opinion on it. So, do some due diligence, find some good companies that you want to buy that are trading at really good valuations and pile into those. And says this vid might help you out. This is value investing with Stephen Carlson. So you could check out his video. I haven't watched this one, by the way, but I'm guessing he shows the differences in dollar cost averaging. And he probably says, most studies at least say that lump summing your money in has a better return than sitting on the sidelines and dollar cost averaging. And the reason why is simple. The market usually goes up over time. That's what it does. The market usually goes up. So the more money you have in the market, the more money you'll make in the future. That's the most boiled down basic logic. That's what all the studies show. The quicker you get money in the market, more than likely you'll make more money. There's some specific scenarios as if you lump sum right at the peak before a market drop, then it would have been a little bit better for you to dollar cost average. That's usually not the case. So you can take that for what it's worth. If I were you, if it's a small amount of money, and by small I mean $5,000 to $10,000, nowhere close to being able to retire or do something extravagant with, I'd put in right away. If it was $100,000 or more, I'd break it up into chunks and I'd still aggressively invest it, but I would break it up into chunks and I'd do it a little bit more disciplined manner. Oren says, let me make sure I didn't miss any. Freddie says, do you think limit orders would be a good feature on M1? I don't think so. I don't think there's any reason for it. Oren says, how many holdings and positions should I have? You have 24 in your passive income account. I currently have 40 among multiple sectors. Alvarez says, is with everything, it depends on what, if you want to diversify, but not so many that you can't keep track of all of them. People, my opinion on this is, Warren Buffett and them say that diversification is insurance against ignorance. So you don't need to know as much about each company as you diversify. If you own 100 companies, you don't need to know anything about them. You could just pick the top 100 companies, the S&P 100, and you'd probably do good. That's being honest. It'd go up in value. You do okay. The less companies that you own, you really have to do your research. Really make sure that you're very competent in investing. And by that I mean, what a PEG ratio, what PE ratio is compared to the average of the industry. What the cash flow of the company is, the expected returns, the risk involved, the moats, the competitors. You really need to have a well-rounded view of those companies if you own less than 7. That's my opinion. If you own less than 7, you need to know a ton about the companies and be very competent in investing. And as you go out beyond 7 companies, you don't need to know quite as much. You can have a portfolio of what I have, 24 companies. And as long as you're doing an okay job selecting them, it diversifies the risk a lot. I would never recommend owning less than 7 companies. I just don't see, even the best money managers, even people like Michael Burry and Warren Buffett and people that have concentrated portfolios, they all own more than 7 companies. So I don't think there's an argument to be made of why you should only own one company unless you're barely getting started and you don't even have enough money to invest in 7 companies. So in my opinion, I wouldn't go below 7. I think that if you have 7 companies, that's a very concentrated portfolio. There's more than 7 good companies that exist, and you can diversify away a lot of systematic risk or non-systematic risk by owning more than 7 companies, 7 or more. So, you de-risk your portfolio a lot without giving up returns, owning at least up to 7. But I wouldn't own more than 30. I think that gets to the point where it gets hard to manage that many companies. I've had more than that, and it does get tough to manage. I don't know how to say your name. It says, is it possible to add European stocks to Qualtrim? I've been looking at this, adding ex-US stocks, and I think there is a way, but I'm not sure how to do it yet. I'm working with IEX data, and it's like I have to plug in special things for each call, so I'm going to be looking at that. It's definitely our next goal. Right now, we're still building out a few things to get it into the App Store. Apple sent us like a list of stuff we have to do to get it in the App Store, so we're going through that list. It's kind of tedious. But once we get done with that, we're going to be focused on Qualtrim, and there's a couple features we're focusing on. One is supporting different exchanges outside of the US. That's going to be a big one. And then also combining portfolios. And then I'm going to be simplifying some of the views. So like the upcoming dividends and the ones that are declared, that's just going to look a lot more simple. So we should have that stuff be supported soon. How to use the dividend tracker. That's one that asking this channel right here, project discussion, portfolio tracker. That's where we talk about support for Qualtrim and the dividend spreadsheet. I am coming out with like a version 2 that has some updates and changes to it. It'll be a little bit different, but you'll be able to just copy the data over. And I'm fixing the parts that people struggled with. So like some of the graphs that people had a hard time with, I'm going through and I'm updating that and making it easier. So hopefully it's easier to use in the future. I'll keep updating the dividend spreadsheet, and you guys can swap over to the new one if you want to. Is the Google Doc tracker a replacement for Qualtrim? Seems like duplicate effort. It's not a replacement, but it is a way that we can rapidly prototype some of the views that I want to make without the effort of programming it and then trying it out first there. So I look at Qualtrim as kind of like, this is like the stuff I know I really want that I'm going to go through the programming effort and make it into an app. And then the spreadsheet is something I can quickly make a bunch of visuals, see what people really like. And then if they love one feature in it, I can bring it over to Qualtrim. So, and then there's some people that really just like spreadsheets. They might like it more than Qualtrim. So you guys can use either, or you can use neither, or both. But they're both just projects we're offering. But actually, the spreadsheet actually helps with the development of Qualtrim by prototyping a lot of things that we can put into Qualtrim. Let's see. Does this work with all trading? I use Revolt, and they don't have an export option. Every brokerage should have some type of export of your holdings. That's all you need is basic holding data. And I am going to make it so that you don't have to put so much data in the spreadsheet. You'll just have 3 columns, like you have to put in the ticker, your share count, and then your average cost, and that'll be it. And then it will generate a lot of the other information just with that. So it should be easier if you're using other brokerages. So repost. Okay. I skipped over this one apparently. Rage of Anarchy says, hi JC, congratulations on quitting your 9 to 5. I've always found great respect for people who can make such bold moves in life. My question today is about portfolio management. How do you decide which holdings to put your cash into? I understand M1 makes it easier for people with fractional shares and weightings, but I'm stuck with the problem each paycheck of deciding, do I want to buy this or that, or YOLO into Hydrofacial? Well, Rohan, one of our chief analysts, would say to YOLO into Hydrofacial. So, you know his answer. My answer would be, I'm trying to develop a feature that will help give insights into potentially good buys. I'm going to call it the dip finder. And really all it's going to be is, I know that we don't do a lot of technical analysis here, right? I'm not going in with candlestick charts and drawing lines and graphs and going into support lines and resistance. So I'm not into all of that stuff, but I think that there are some things that you can look at to potentially find dips in companies that you already have done a lot of qualitative research on and that you really like the companies. So if you have 10 companies that you love, that you want to own more of them, you think that they have characteristics that make them very good companies, and you're just trying to decide which one to buy, I'm going to be developing a feature. It will be in the new version of the spreadsheet. There'll be a dip finder. It'll tell you what companies are currently experiencing a dip in your portfolio. And the way that this is going to be done is it's going to look for companies that are trading below their 200-day moving average. So companies where the price went up and then it's recently gone down and it's experiencing a dip, and then its current price is below its 200-day moving average. So there's different ways that you can find dips in companies you're trying to buy, but it's a very illustrative way. It tells you kind of This is what the company has done so far, and it's currently going through a dip. And a lot of times those are companies that really are not getting a lot of love by the market. They're just trading downwards. So if you have like a graph that illustrates what companies are experiencing that, and the opposite, what companies are experiencing a huge spike in your portfolio, this will be one graph that will be like a bar chart that will show you all the companies in your portfolio experiencing a dip and all the companies in your portfolio trading at historically, they're trading very high. They're kind of moving up rapidly. So it'll give you some ideas. It won't tell you what to buy because again, companies can experience dips because they're actually going in a bad direction or they had some really terrible thing happen, but it will give you ideas of what companies are dipping in your portfolio. And as we say, we want to buy the dip. So let me try to find where I was. All right, we are right here. Ghost429 says, can we get tiny URLs or something to get updated with the latest version of the portfolio? Yes, I have been posting those. I recently posted the latest version on Patreon, but I should update that more frequently. Keep in mind, whenever I make a buy, Ghost, I'm not changing the allocation of my portfolio on M1. I'm not changing my target allocation. So a lot of times I do buys, but the target allocation stays the same. So I try to give you direct notification of what companies I'm buying, my reason why. And then I'll even give you screenshots showing you what the value is, what my returns are, and what the target allocation is. And I think the screenshots are more helpful because when I just give you the link, it just shows you my target allocation. It doesn't show you my current value or how far away I am from that target allocation. So the screenshots are very helpful as well. Yarrow says, hi, Joseph. For those of us who do not use M1 Finance, what if I could, but I'm in Europe? I know, I wish it was in Europe. Would you be so kind to share how you calculate cost basis to add to the new stock spreadsheet that spoke about in the previous video? The average cost basis is basically the current value of the holding compared to what you paid for it and the difference there. That's how there's formulas on how to calculate it, but that's all it is. It's saying I bought it for this much and now it's trading at this much. What was my cost basis compared to what it is? But every brokerage should show you your cost basis. That's like your share count and cost basis are super fundamental brokerage things. I'm sure that yours shows it somewhere. I bet you're just not looking in the right place. So I'd ask some people on support if they're using the same brokerage in like the European chat, eToro. I'm sure that it shows that. Every brokerage should show that. This will show you the formulas to enter into spreadsheet. So somebody else is helping you out there. Joe King Forever says, Joseph, have you thought about starting another channel focused on interviewing folks in the business and or financial YouTubers? I plan on doing that. I did the interview with Brian Barnes, but it's such a difference of what my normal content is that it never gets as high view counts. So my videos are getting really good view count. I mean, 60,000 plus every video on basically any subject. But then I do an interview with Brian Barnes, which personally I think is a very interesting subject. I mean, I got the CEO of a fintech startup company that's growing rapidly, that's one of the most relevant newer fintech companies out right now, and he's giving his input on overall fintechs and banking and how things are going to change in the future. And people aren't as interested in that as the other content. But I know why. They come to the Joseph Carlson show expecting a certain format, and they're not getting it with interviews. It's a totally different format, not what people have been. That's not what they hit the subscribe button for. They didn't want an interview show. So when I do interviews, I'm not going to create a new channel, but when I do interviews, I'm going to instead do it on the After Hours channel, because then at least it's a little bit more familiar. I'm sitting down, I'm talking, you can see me on camera, and I'll just be talking to someone else on those ones. I do plan on doing one with Christopher Volk in the future. He's the CEO of Store Capital. He's super smart. Like, he knows so much about real estate. It's going to be an intimidating interview to do because this guy, when I read the comments, I'm like, I understand some of the words, what those mean. What he's saying is crazy intelligent. So it'll be fun to have him on here and inform us about REITs and real estate and a lot of things that I think he can enlighten us about because he's very successful in it. I haven't scheduled a time yet. I still need to test some things with the interview before I do it, but it'll be on the secondary channel. I'm not going to create a third one. I just think it wouldn't have enough updates. I'd have to be doing interviews all the time to keep the channel fresh. And so having already 2 channels is enough to keep updated right now. And interviews are they take some time and prep work to do them if you want to do them well. So that one will be on the secondary channel. Harvey says, hey, Joseph, thank you for sharing the spreadsheet. Small observation. It'd be nice to order the incoming dividends windows by date. Oh, Harvey, you don't like having them just random orders? Yeah, okay. We did have them. This is an issue that I realized after releasing the first version. Mine, by random chance, were just in order. So I was like, oh, good, they're in order. They weren't in order. Mine were just randomly in order. But I see the problem. It's been fixed. This will be fixed in the next update of the of the spreadsheet. So the next time I come out with an update, they'll automatically order themselves in order. So you'll have that. Okay. Yeah, so joking informs you there. Rich says, hey, Joe, love the way things are going along since you started full time. I've been withholding a large amount of cash on the sidelines waiting for a buying opportunity. I really want to get into the market and commit to only keeping a reasonable emergency fund. I fully understand that time to market is better than timing the market, but with that being said, it's a bit hard to stomach the idea of much more than doubling my investment capital while continuing to see all-time highs and big inflation concerns. With all being relatively short time, what are your thoughts? Do not make the mistake that Peter Lynch talks about continually of looking at the economics, seeing the scary headlines and being scared with your money and sitting on the sidelines. Scared money will not make money. You won't make money sitting your money on the sidelines. I promise you that. In fact, you will lose money. So I have an emergency savings. I have over $100,000 right now in cash, and I'm constantly looking for ways to deploy that. And part of it is just because, I don't have a real job. I'm a YouTuber now, so I feel like I should have more cash than the average person that has a salary. But a bigger part of that is I'm realizing that just keeping this cash, if I have $100,000 in cash, I pay a hidden tax of probably 2 to 3% at minimum every year, because inflation is going to be 2 to 3% at least. In my opinion, it might be even more than that. With $100,000, that's like paying $3,000 or $4,000 a year extra in taxes. $3,000 or $4,000. That's a lot of money for just a $100K in tax that I'm losing. It's gone. That buying power is completely gone. And then on top of that, that's not the only cost. If the market goes up this year, if it goes up 20%, and I had, $100,000 in cash, how much more did I lose off of that? Another 20% of 100,000? I lost 20,000. So I lost 20,000 plus inflation, $23,000. That's what happens if the market goes up 20% and I'm holding $100,000 in cash. The point being is, you are guaranteed to lose money if you hold cash over the next 10 years. It's a guarantee. Anything else, the market's going to go up over 10 years. If anybody, unless you're somebody like Peter Schiff or somebody that's always bearish, you believe that the market will go up over time because capitalism expands, markets grow, companies grow, they become bigger and bigger and bigger. Companies like Disney, HBO Max, Netflix will have 2 or 3 times the amount of subscribers they have. They'll have revenues of 5 times that they currently have. I mean, capitalism is going to continue to go, so you need to put your money to work. That's the point I'm making. Don't be scared out of the market. And if we have a dip, even if you have money invested, that's okay. Being in the game and having your money go down a little bit in paper, and then you can continue to buy companies because you're still going to be working. You'll still be employed. You'll still be able to buy these stocks. Just don't be, don't go too far to the other side of being so aggressive that you're leveraging your money, you're taking out second mortgages, you're buying a home that you can't even afford, and you have a job that's not stable, and you have no savings, right? Don't push it that far to where you're being that aggressive, but also don't go so far that you're being too conservative. I think there's a lot of money to be lost by being too conservative. So my thoughts are, ignore all the things about the market being at all-time highs. It's good to know that, but you can buy companies that are not at all-time highs. I've been buying those consistently over the past 3 months. AT&T is at an all-time low. It's trading at a 9 PE ratio. Look at the historical graph. It's just crept down more and more and more. Most people think that makes a company risky. When a company continues to have good cash flows and it's earning money and it's growing its business, but it's trading down more and more, that makes the buy less risky. You're paying less for the same asset. I'm paying a lesser price for the same company. So you can do that with AT&T, Verizon. You can do that with utilities. You can buy real estate right now. You can buy, I think, even some financials that have gone up. There's still room to run for those. And you can buy I think a lot of the big tech companies are undervalued. I think Google's undervalued. I think Facebook is. I think Apple's coming down a bit. It's probably getting to a more reasonable valuation. Microsoft is one I've considered buying. I don't think it would be a bad buy right now. So there's a lot of places to put your money to work. I would find something you're comfortable with and continuing to invest, because if you sit here and you're worried about market sentiment, the market could go up 30% this year. And the opportunity cost is pretty big if you're not in it. So just keep that in mind. Sleepy Grandma says, hi, Joe. Do you feel that Starlink could potentially disrupt the telecommunications sector? For example, T seems to be well diversified enough that even if the telecom business is reduced, their media could still provide consistent cash flow. I'm bullish on T and agree with your thoughts on HBO Max being the third biggest player. Would love to hear your perspective. Well, first of all, I would not invest in AT&T if you think that something is going to materially make their telecom portion of their business irrelevant, because that is by far where they get the majority of their free cash flow. HBO Max right now is kind of it's like the growth part of their company, where it's not that profitable, but they're growing it like crazy. And it could be a highly profitable business in the future. It's just not at that point right now, but they're growing it really rapidly. So my thoughts are, I don't think so. I don't think that the telecom business as we know it is going to completely radically change in the next 5 years. I think it'll take a very long time to do that. It just is something very unproven, I think unlikely. So we'll see what happens with it. But I think Verizon and AT&T are well positioned in the future. Freddie says, did the work from anywhere and the economy post-COVID make growth opportunities for WeWork so that we can revive themselves? Or does Airbnb continue to penetrate the flexible workplace market? I don't know if Airbnb is. I don't know if they're in the workplace market that much. I think that WeWork, the big problem with it was valuation. It was a $50 billion company that made no money and was in a lot of debt and had a very unproven business model. And, it just was at a crazy valuation. So I think they've redone the valuation and now it's like a $9 billion company, much more reasonable. That changes the story a lot. If it's $9 to $50 billion, I think it's a much more reasonable valuation. And then Airbnb, I think that's one that probably should be in the story fund, but I can't. A lot of the price, I think, is already factored in. A lot of the growth is factored into the price right now. P. Cherry says, Joseph, how do I download the CSV from M1 Finance? I don't see a download link under the Excel. Somebody gave you the M1 exporter there. You use the M1 exporter to download the holdings. All right, and the monthly statements. You guys are talking about that. Okay. Joseph, Clubhouse chat discussion topic suggestion. Different holdings that make more sense in different accounts. Example, JEPI, SCHD, QYLD, REITs, ETFs, and taxable or Roth. Yeah, I could do that sometime. Talk about the different types of accounts and what works best with them. A lot of that is kind of up for debate, but you could give an overview of the implications on taxes in different accounts. Woshi Sam says, Joseph, just imported my holdings on the spreadsheet. However, my upcoming dividend charts looks funky. Is it related to the fact that the couple of dividend yields in the holding chart is still loading? Yes. If it doesn't have like the X or Y, that's just because it's currently loading in the data. It'll take a few minutes and then it usually gets figured out. I think that it's not my server. The spreadsheet itself, Google Finance, only allows certain amount of API calls per minute. So they try not to like DDoS the website, right? They don't want to overload it with calls. So they're the ones restricting that. I wish I could take off that restriction and allow it to do all the calls instantly because my server could handle it. These aren't heavy load calls. Okay. This is another one. Hey, some of my graphs, yearly dividend growth rate and portfolio value look funky. I was wondering if anybody could help me out. Yeah, that would be for the project discussion. A lot of these issues have been fixed though. Wally says, hey Joseph. This is more of a suggestion than a question. With more and more people joining the Discord, the amount of conversation data is increasing. A lot of people asking, where is this? How could I find this? Of yours, I think it would be nice to have a reference channel that only has one comment with a list of all your links, spreadsheet versions, portfolio links that you can regularly update. I could do that. I've thought about that. I have a message that goes out when everybody joins. That's a pretty comprehensive message. The big issue with adding another channel is we got limited real estate and we have a lot of channels. So as I add more and more channels with rules and general and new members and that type of thing, it pushes down the other channels, but these are still really important. But then you're having to scroll more and more. So we have channel creep going on. We could create more and more channels, but sometimes for people, it's already a lot to keep up on. So I'm trying to keep the channel creep, the growth of all these channels, to a minimum. So the only way I'm going to create a new channel in this Discord is if I just think it is overwhelmingly necessary to have. So there is an absolute reason we have to have that channel. And we can have other people kind of vote and give input on it if it's worth it. Ricky says, now that the SEC declared Coinbase one of my biggest crypto exchanges, S1 registration statement effective, they are expecting to go public April 14th, 2021 with classic common shares. What are your thoughts about this? Would you consider investing in something like this? I think Coinbase will continue to grow and generate profit with cryptocurrency gaining traction over the next 5 to 10 years. I'm sure this one's going to go crazy. I think this is going to be one of these ETFs that goes up like nuts, that people can't buy enough of it because it's the new thing. It's the new thing. We have NFTs, we have crypto. You can see that it's drawn a lot of people's attention. So you have the more boring forms of investing, real estate in the stock market. And that kind of was like a fun portion, but now it's like crypto, NFTs, all this type of digital goods. This is the new form of investing. And you can even see popular investment channels like Andrew Jai's, his pretty much transition from dividend investing to a crypto channel from what I've seen. He talks way more about crypto than he does about like real estate or dividends or anything else, because that's what people are viewing and watching right now. In my opinion, I think the same type of investments that have been the best investments for the past 100 years and the past 20 years, I think will be the same, the best investments for the next 20 years and the next 100. I think that stocks and I think that equities, owning companies, is going to be the best investment over the next 100 years. And I think that real estate will be the next best investment over the next 100 years. I do not think it will be crypto. Crypto's had a boom right now where we have monetary policy with tons and tons of easy money, right? Low interest rates. Anybody can get loans. No problem with it. Tons of student loan delays and forgiveness, and you don't have to pay you don't have to pay for the real estate, for the rent right now. You can defer it, and you don't have to pay taxes on stuff, and you're forgiven, and you have child tax credits, and you have stimulus checks coming. You have tax delays on stuff. There's so much easy money going on right now. Even with businesses, they can pay their employees more because they got a ton of money with the PPP loans and all these type of stuff. Money has been so incredibly easy to get over the past 3 years. The people have got it in their heads. This is the new normal. This is what life's like. Money is everywhere. We can get it without any trouble. I'll never be in a situation again where money's dried up. Nobody wants to give you a loan. Nobody's handing out free money. And now you're nervous about your financial situation and you only want to stick to what's tried and true. That's not the situation we're in right now. And a lot of people lose sight. They have recency bias. They think that the recent way that things are happening is going to be how it is in the future. In my opinion, the result of the huge boom in cryptocurrencies, the result in the huge boom of like NFTs selling for $69 million, right? Something that's an investment made up over the past 2 or 3 years, commoditizing digital goods. These type of things, some of them will stick around for a long time, but this boom to me of all these less tried and true investments, I think is a result of the easy money policies. And I think that when those policies dry up, when interest rates inevitably go back up, when money's difficult to get because companies don't have as much money, they can't loan it out, they can't get loans at cheaper interest rates, I think a lot of this type of stuff will revert back to the tried and true investments. Now I actually want to own real estate, I want to own stocks. And so that's kind of my attitude about it right now. I want to own the things that I know I'm going to make money with. Not that I think I might make more money with, but that are uncertain. I know I'm going to make money with stocks and real estate over the next 10, 20, 30, 40, 50, 100 years. I don't know about cryptocurrency that much. I think it's very unproven. We don't know how governments are going to regulate it. With a lot of different type of things that governments don't like, they do some regulations that are pretty harsh, and it takes away a lot of the expected returns. You can look at what Uber's dealing with, right? They're interrupting and they're disrupting a taxi service, and you can see the massive amount of regulations that the government's doing on Uber as opposed to like Google or Microsoft, where they're not really disrupting something like they are. So a cryptocurrency comes in and it's going to disrupt fiat currency. It's going to disrupt the US dollar. You better believe if the government starts to believe this is a problem for them, they're going to effectively do things to constrain the use of it. They'll make it so it's similar to their current currencies. So I don't know. I'm not going to be putting a ton of money into cryptocurrencies, and I'm not going to be putting a ton of money into different companies. I think it would be better to invest in companies like Coinbase than it would be in cryptocurrencies, in my opinion, because companies like Coinbase, they win no matter what. Whether cryptocurrency does good or bad, they just take a little bit in between and they win either way. So that part I think is fine. I'm long on most companies, most equities, but I do think that this type of boom will eventually wear off. And I think that we're going to go into a time over the next couple of years, we're going to go into a time where money is going to be harder to come by, and we'll see what type of investments flourish when money is uncertain, when the current environment's uncertain, and there's not as much easy stimulus policy going on. Angie says, Joseph, I'm so happy with the release of the portfolio spreadsheet tracker. I'm glad somebody enjoys it. I know we have Qualtrim, but I think the spreadsheet tracker, it'll appeal to different people. You guys can use both or either, but I think it's a fun thing to have. It looks awesome and finally has all the data you would want in a portfolio tracker. Unfortunately, I'm from outside the US and my broker does not give the same CSV data required in the spreadsheet. I just can't get it to work because it doesn't accept my manual data. I'm not sure how to go about this. Is there a solution? Yes, in the upcoming version, like I said, it's going to have a reduced amount of stuff you have to enter in. You'll just need the 3 columns, the stuff you'll need. And there's no way around this. Like, I can't get around this. You have to know this about your holdings. Your average cost for your shares, your amount of shares you own, and the ticker symbol. I have to know those 3 things. So you can calculate all of them. There's a formula to calculate the average shares. You can look that up on, or your average share price. You can look that up online. But your broker has to give you your share count and the ticker symbol. That's just the most basic data. They wouldn't even know what you own if they didn't have that. So you'll have that data. You can plug that in and it will populate the rest of the stuff. All the different data, the dividend yield and upcoming payments and all that type of stuff will be populated. But that's going to be in the next version. I'm fixing a lot of bugs and we're working a lot of things. This is kind of like a beta testing. I didn't call it a beta testing, but version 1 is kind of a beta test. Again, I don't know how to pronounce this. So sorry about that. What do you think about the oil industry going forward the next 10 to 20 years? My position on oil hasn't changed. I said early on when I was exiting my oil positions, I said, people are going to make money with oil in between now and when the oil industry dies. It doesn't work like the industry dies and so the stock chart just gradually goes down steadily without ever going up for the next 20, 30 years, right? There's people that are going to make oil, and a lot of people did. During the past 3 or 4 months, look at what ExxonMobil and Chevron have done. They've gone up like crazy. They've outperformed growth stocks like crazy over the last 3 or 4 months. So a lot of people did make a good play on oil buying into it when it was overly pessimistic, overly sold, and that's recovered. But long term, the view still holds. Oil's not the energy of the future. As a society and as a people, we're going to move on to different forms of energy that are more efficient. They're a little bit healthier for our planet, right? We're making a big push for that. It's going to be slow going. So this is going to be a whole shift over our generation. It's not going to be like the next 5 years ExxonMobil's out of business. It's not going to happen that way. These companies will probably be around for the rest of our lives. They'll just become a little bit less profitable and have less opportunity as we really move over to companies that are green energy ones, right? Solar companies, windmill, we move over to those type of companies more. And I think that will happen. But again, the market's already priced in some of that. I'm not bullish on explosive oil growth over the next 20 years. I think that it will kind of be like cable TV where it will be around, but it will slowly be transferred to other industries. And I think that some of the oil companies are already making those jumps. A lot of the European ones are doing that. They're sacrificing short-term gains right now with oil to transition their business to renewable energy. So we'll see more of that going forward. Megamix says, as part of the increased knowledge about investing, why do you not start trading options to generate monthly income based on your holdings instead of buying JEPI? I could do that. There's a couple reasons why. One of them is that M1 Finance doesn't allow options, so they don't have option trading right now. So I'd have to start a different brokerage or use my Webull account. I have like $2,000 in a Webull account from the free stocks that I get. But with JEPI, it's just so easy. I pay a low expense ratio and I have somebody doing that. And these are experts doing it that work at JP Morgan that are, they're industry experts. They know what they're doing, and I'd have to learn a lot of new stuff to do that. And I'm focusing my efforts on trying to consistently buy valuable plays, valuable companies over a long-term basis. So that's where my effort and my mind is going. It's not on learning monthly options, but I think you can do that. I think it's a good strategy. Tone says, Joseph Carlson, hello, I'm figuring out your spreadsheet. My question is, how do I manually input information, like what my portfolio value was the month I started and the month later? How do I get that information? Your brokerage statement will say that. If you go to a monthly brokerage statement, they'll say the ending balance. And I just use the balance from that plus the month, and I plug it into a graph. And again, it doesn't have to be super precise. It just shows you your progress over time, what happens with portfolios as you consistently dollar cost average and deposit a portion of your paycheck. It's going to go up over time. But your monthly brokerage statement will have that. Just look at the settings of your brokerage, go to your taxes or statements or whatever they have it, documents, and you should be able to download that and easily see it. And if not, most brokerages have a chart over time. Like M1 Finance has that right on the dashboard. It tells you every day what the ending balance of your portfolio was. So I could just highlight any day and see it that way as well. Captain Levi says, I was wondering what your thoughts about getting paid interest on crypto holdings. A few companies like BlockFi and Celsius pay 6 to 8% interest on your deposited crypto. I know you said you weren't going to invest in crypto, but you could just have USDC in the account and use it for super high yield savings account. What is your opinion on using that method? Okay, here's my opinion. I talked to the guys at BlockFi. I had a conversation with them. I talked to them for about an hour, and I kind of grilled them on some questions. How safe is this? What is your chance of liquidity issues? And they gave good answers on it. They've been through times where there's been a squeeze in the price of crypto, and they were fine during it. They're not FDIC insured. They're not SIPC insured. There's no government insurance for any of this. Which makes me nervous. Even if the company has done well so far, that makes me nervous, because if a company goes bankrupt or they have any issues and you don't have that insurance at any part, and it's something like crypto, I can't imagine the government being that helpful. They're really not going to do anything to help you. So that's one problem with it. And another thing is the reason they're making the 6 to 8% interest on it is because it's new right now. And a lot of places want to have access to crypto very easily, but that's going to dry up pretty quickly. This isn't a long-term thing. Those interest rates, they're going to go down. They'll get compressed as crypto becomes more popular and more companies jump onto doing this. So that 6 to 8% will move from 6 to 8 to 5 to 7 to 4 to 6 and so on and so forth. It'll creep its way downward. I think it's fine. A lot of creators are doing this. Meet Kevin's doing it. Andrew Jike's doing it. Keep in mind, the affiliates for doing crypto are insane. So the amount that I would earn doing a crypto affiliate as opposed to anything else like Robinhood, Webull, M1 Finance, right? All the different options of earning affiliate money, crypto pays way more. It's crazy amount more. And it's based off of how many people deposit. So it makes sense that a lot of content creators are shifting towards this. But I'm not about I'm not about pushing my audience or pushing my viewers into whatever is going to earn me the most in affiliate money, right? I have to go with what I think is the best investment for them and their future finances, and their family and that type of thing. What's going to serve them the best. And I just can't, even if it's a small portion, I can't right now be assured that this is a proven good investment in the future that I would feel comfortable putting all my family's finances in. If I was to go to my brother or sister or whatever and say, hey, I'm going to put your money into the best investments, I'm going to put it all in BlockFi and earn interest on that. I just wouldn't feel super comfortable doing that. And so I treat my audience the same way. If I couldn't recommend it to my parents or I couldn't recommend it to my family, people that I really want to have a good financial future, I can't recommend it to my audience. That is the reason why I haven't pushed it right now. Even though they message me on Twitter, they want me to do it, they pay good affiliates, they so far I think have a good product. It's just that kind of unknown that this is something I don't know much about, doesn't have the same insurances, it doesn't have the same proven history. I think is very volatile, and I don't want to do whatever is best for my pocketbook. I want to do whatever I think will set up the people here on the Patreon and the people that are listening to me the best for the future. That'll create the most wealth in a risk-adjusted way, with risk being a factor, what is going to set them up the best. So that's the reason why. I'm not saying it's a bad investment. I'm not saying you should stay out of it. You can do whatever you want, and I don't necessarily think that this is a bad idea. I'd warn you against it if I thought it was a bad idea. Like I warned people against Nikola, 3 or 4 months ago or whatever. I said, this is a terrible idea. This is a terrible company. I would not put my money in it. So I would warn you if I thought this was bad. This is not something I see as bad. It's just unproven. I don't plan on jumping onto it because it's popular on social media right now. And like I said, I think a lot of the popularity will fade as easy money dries up a little bit and as these margins come down, because more companies are going to do this, and the 68% is not going to last for long. Parm, I think, says, Joseph, what do you think about the new residential investment NRZ? It has an 8.5% dividend yield. I lost $1,000 on that company. So that was one that I bought high. I sold low, learned my lesson, stick to what Peter Lynch says, buy what you know. I just don't understand the company. I tried understanding mortgage REITs. I really don't understand them. And I thought, okay, these have risk. Boy, did I underestimate the amount of risk that they have. Those things can plummet in a heartbeat. So if you're okay with the fact that your company can plummet in a day, it can go down 50% in value. Mortgage REITs are crazy volatile. So they're not stable. They don't necessarily grow their dividend. They just pay out a high amount of interest, and they're extremely unstable. You can invest in that. I should have been better prepared, and I probably should have just held the company. But I really, I wanted to raise money for different investments that I knew more about, and NRZ was one of them. So my thoughts on NRZ: if you're investing in this, realize that you're buying something that is extremely volatile. It'll probably make you money and it'll have these high yields. But if we run into any market trouble or anything happens, this is an extremely volatile holding, as is most mortgage REITs. Duck Blast says, Joseph, what are your thoughts on selling put options on companies you believe are overvalued? Would you ever employ this to your portfolio? Curious because I found that Buffett is an endorser of this. Why or why not? Yes, Buffett has used options, something that most people don't know about, because he's looked at as just, the long-term holder. He doesn't do any complex strategies. He uses options to enter positions. I don't plan on doing it. It's just, again, M1 Finance doesn't offer it. I think it would move the needle if you're moving as much money as Buffett. For my portfolio, I don't think it really would. I don't think it would make as big of a difference. Okay. Yeah. Pram says, doesn't look like he answers questions here. That's true. If you were just to look at the chat feed, I don't answer them, but I do videos like this. So let's see. Falcon Punch. So Falcon Punch says, Joseph, what is your take on MasterCard and Visa? I understand that tons of people use these credit card brands. I own both holdings in my portfolio for about 2 years now. The earned dividends each quarterly is awfully low. Okay, if you own these for 2 years now, you're talking about the earned dividends being low, but let's keep reading this. Not to mention the market gains that I've earned in that time span have been very low as well. I understand why everyone has these holdings in their portfolio because everyone uses the credit cards. I'm just disappointed in their performance. What are your thoughts with these holdings? I think that MasterCard and Visa, in my lifetime, will both be trillion-dollar companies. They'll have a market cap of over $1 trillion. I think both of them will. They have a network nothing has a network even close to these guys. They have the biggest network when it comes to digital transactions, and they can continually add things into their network, and the cost advantage is so monopolistic. Basically, they're the only competitors to each other. The markets has been low on these companies, but that's because look at what the market's done. It's bid up a lot of companies that aren't as good as MasterCard and Visa that have a little bit more growth potential. But again, that doesn't mean that you shouldn't own it. Don't base it just off the past 2 years. Look at the performance of these companies over the past 10 or 20 years. They're great companies. I think they'll continue to grow. And I think in the future, they'll do the same thing as they secure more of a moat. They have a low payout ratio right now. They have high reinvestment opportunities. The biggest downside of MasterCard and Visa is probably government regulation. So that's probably the biggest downside. But I think you keep those in your portfolio. You don't have to pile into them by any means, but I think you keep them in your portfolio. And I think that if you have any opportunity to buy them where they go unreasonably low, like a market sell-off and people just panic sell out of funds that include these, I think you pick up some shares because the risk-adjusted return on these companies, I think, is very good. They're going to make slow, consistent gains over the next 10 years. They'll compound your wealth for you. Michael says, performance hasn't been bad. Visa has about matched SPY's return. Yeah, calling performance bad that's matching the general market, that's not, Visa hasn't been hurting investors. You haven't been hurt by investing in these companies. But that is the last question. So again, we have another new member. I appreciate all you guys for joining and trying out the Discord. I'll try to have more exclusive content out as well as more content in general. I was planning on having another update on my secondary channel on Saturday, but we were doing family stuff on Saturday, doing Easter egg hunts and stuff, and I have more of that planned today. So I'm going to have to put that off, but next week I'll be a lot more free. I'll have a lot more episodes out for you guys, but I appreciate you guys for tuning in. And let me know on the Discord if you have any questions. I'll be on it throughout the day. So I'll see you guys later.